Have you seen what's happening with silver prices? It's been a wild ride. On Friday, we saw silver take a massive nosedive, dropping over 4%. Some people might be quick to blame this on simple price volatility or market noise, but I think there's a much deeper story here. What we're witnessing isn't just a fluctuation, it's a potential crack in the very structure of the silver market. Let's break it down. For weeks, maybe even months, the market has been building up a massive number of long positions. Everyone was betting on silver going up. But here's the problem. When a market gets that lopsided, with so many people on one side of the trade, it becomes incredibly fragile. Think of it like a Jenga tower where all the blocks have been pulled from one side. It doesn't take much to make the whole thing come crashing down, and that's exactly what happened. A little bit of selling pressure came in, and suddenly it triggered a cascade of stop-loss orders. Those who were long were forced to sell to cut their losses, which pushed the price down further, triggering even more selling. It's a classic domino effect, a textbook example of a long squeeze. This isn't about the fundamental value of silver, it's about market mechanics and poor structure. The foundation was weak, and it finally gave way. Now, you might be wondering, what does this mean for the future? Is silver doomed? Not necessarily. What this event really highlights is the danger of a crowded trade and the importance of understanding market structure. It is a powerful reminder that prices can be driven by technical factors just as much as by fundamentals. When everyone is expecting the same thing, the market often has a way of surprising you. So the big question is, where do we go from here? The market needs to find its footing again. This washout of long positions could actually be a healthy thing in the long run. It clears out the weak hands and allows the market to rebuild on a more solid foundation. It's a painful process for those who got caught, but it's a necessary reset. We need to watch carefully now to see if buyers step back in with more caution or if the sellers maintain control. This whole episode is a fascinating case study in market psychology and technical breakdowns. It's not just about a price chart, it's about the collective behavior of thousands of traders creating a self-fulfilling prophecy. The sharp drop wasn't random noise, it was a symptom of a structurally unsound market. Understanding this distinction is key to navigating these turbulent waters. Thanks for watching, and if you found this breakdown helpful, be sure to like and subscribe for more market analysis. I'll see you in the next video. Have you ever looked at a price chart and thought, something just doesn't feel right? That's what many of us are feeling about silver right now. It's not just about the numbers going down, it's about the very structure of the market that's raising some serious questions. Today, we're not just going to talk about price drops, we're going to peel back the layers and examine the integrity of the silver market itself. Let's set the stage. Silver recently experienced a pretty dramatic plunge. On the surface, you might hear analysts chalk it up to typical market volatility, maybe some strong economic data, or shifts in industrial demand. But when you dig a little deeper, the story gets a lot more complex. The speed and scale of this drop seem to defy traditional explanations, leaving many experienced traders and investors scratching their heads. So, what's really going on? One of the biggest points of discussion is the massive disconnect between the paper market and the physical market. The paper market, think futures contracts and ETFs, is where most of the price discovery happens. But this market is many, many times larger than the actual physical silver that's mined and available. This creates a situation where a huge number of claims exist for every 1 ounce of real silver. When a massive wave of selling hits the paper market, it can drive the price down dramatically, even if the demand for physical silver, the coins, the bars, the industrial components, remains strong or even increases. This is the crux of the problem. People who want to buy and hold actual silver are seeing prices fall, not because there's a surplus of the metal, but because of speculative plays in a market that's disconnected from physical reality. Let's talk about the mechanics behind these sharp drops. Often, they happen during periods of low liquidity, like overnight, when major markets in Asia, Europe, and America are not overlapping. A large sell order can trigger a cascade of automatic stop-loss orders, creating a waterfall effect that pushes the price down much further and faster than fundamental factors would suggest. It feels less like natural selling and more like a deliberate, strategic move. This raises the question of market manipulation. Now, that's a strong word, but when you see patterns repeat themselves, these sudden sharp takedowns that seem designed to shake out long positions, it's hard not to be skeptical. Is the price of silver being artificially suppressed? It's a debate that's been raging for years, and incidents like this recent plunge only add more fuel to the fire. The core issue is that the price is being set by paper derivatives, not by the real-world supply and demand for the physical metal. Why does this matter to you? Well, if you're an investor in silver, it means the value of your asset isn't being determined by its true scarcity or utility. Instead, it's subject to the whims of a financial system that can feel rigged. It undermines confidence. When the price mechanism is broken, it's hard for anyone to make rational investment decisions. It creates a system where the fundamentals don't seem to matter as much as the financial games being played. Think about the real-world uses of silver. It's a critical component in solar panels, electric vehicles, and countless electronic devices. The demand from these industries is growing, not shrinking. At the same time, we're not seeing a huge surge in new silver mine production. Basic economics would tell you that with increasing demand and a relatively stable supply, prices should be trending upwards. Yet, what we see in the paper market often tells the exact opposite story. This isn't just a problem for silver bugs. It's a question of structural integrity for all our financial markets. If a market as important as silver can be so easily disconnected from its physical reality, what does that say about other markets? It erodes trust, which is the bedrock of any functioning financial system. Investors need to believe that prices reflect genuine value, not just the outcome of a high-stakes paper shuffling contest. So, what can we do? As individual investors, it's crucial to understand the difference between owning physical silver and owning a paper claim on silver. Owning the physical metal in your possession removes you from the counterparty risk of the paper markets. It's about owning the asset, not just a promise. Secondly, education is key. The more people who understand the structural flaws in the market, the more pressure there will be for reform and greater transparency. This isn't a call to panic, but a call to be aware. The recent price action in silver is a flashing red light. It's not just noise, it's a symptom of a deeper issue within the market structure. It's a reminder that we need to look beyond the ticker price and question the very foundations on which those prices are built. The integrity of the market is at stake, and that's a conversation worth having. To understand why disruptions in the silver market deserve attention, it is necessary to examine how metals markets actually function beneath the surface. Prices are the visible output of a complex system built on leverage, clearing obligations, and confidence in settlement. When that system shows signs of strain, the issue is rarely confined to the asset experiencing volatility. At the center of the silver market are futures exchanges and clearinghouses. These institutions exist to facilitate price discovery while managing counterparty risk. Every trade is not merely an agreement between buyer and seller, but a web of obligations guaranteed by margin, collateral, and clearing mechanisms. Under normal conditions, this structure allows vast volumes of paper contracts to trade efficiently with minimal physical delivery. The system functions smoothly as long as three assumptions hold. First, that liquidity will be available when participants need to adjust positions. Second, that margin requirements reflect realistic volatility expectations. Third, that clearing members trust one another's ability to perform. When price moves remain within modeled parameters, these assumptions are rarely questioned. Stress begins when volatility exceeds expectations. Rapid price declines force margin recalculations, triggering calls for additional collateral. Participants who cannot meet these calls must liquidate positions, adding further downward pressure. This dynamic is not unique to silver, but silver's relatively thin physical base and high leverage amplify the effect. During the recent episode, several indicators suggested that stress may have approached or exceeded institutional tolerance levels. Reports of execution delays and temporary access issues imply that transaction volume or risk controls overwhelmed normal operational capacity. Sudden adjustments to trading conditions, including margin changes, indicate that existing safeguards were deemed insufficient for prevailing conditions. Such actions are not inherently problematic. Exchanges are designed to intervene when risk escalates. However, the manner and timing of intervention matter. Predictable, transparent adjustments stabilize markets. Abrupt or poorly communicated changes increase uncertainty and it can accelerate panic behavior. When participants are unsure whether they can transact freely, they tend to act preemptively, often to the detriment of market stability. Banks play a parallel role in this structure. Bullion banks act as market makers, counterparties, and clearing members. They provide liquidity by holding inventory and facilitating trades between producers, consumers, and investors. In doing so, they assume balance sheet exposure that is carefully managed under normal conditions. When price moves become extreme, banks reassess that exposure in real time. They may reduce risk by tightening credit, limiting access, or adjusting internal risk limits. From an institutional perspective, these actions are rational. From a system-wide perspective, they can contribute to a liquidity withdrawal at precisely the moment liquidity is most needed. The interaction between exchange safeguards and banking risk controls can create feedback loops. Margin increases forced liquidation. Liquidation drives volatility. Volatility triggers further controls. The result is a market that appears to malfunction, even though each participant is acting defensively and within established rules. What distinguishes this event is not that such mechanisms were activated, but how visibly they affected market behavior. Mature markets are expected to absorb shocks with minimal disruption to access and execution. When frictions become noticeable to a broad range of participants, it suggests that stress was not isolated. Another factor worth examining is the concentration of activity in paper contracts relative to physical supply. The silver futures market represents claims on silver that vastly exceed available inventories. This structure relies on the assumption that most contracts will be settled financially rather than physically. That assumption holds until confidence wavers. During periods of stress, participants reassess not only price risk, but settlement risk. Even the perception of difficulty in rolling positions or accessing liquidity can shift behavior. Market participants may rush to reduce exposure, not because they believe price will continue falling, but because they are uncertain about the market's ability to function smoothly under pressure. This uncertainty is magnified when disruptions occur unevenly. If some participants encounter access issues while others do not, the market ceases to operate as a level playing field. Information asymmetry increases, trust erodes, and volatility becomes self-reinforcing. These are characteristics not of healthy price discovery, but of systemic strain. For decision-makers outside the trading community, these details may seem technical, yet they carry practical implications. Markets underpin supply chains, hedging strategies, and financial planning. When market plumbing falters, even briefly, it signals that stress is migrating from price into structure. The key analytical takeaway from this episode is that the silver market S response revealed fragility not apparent during calmer periods. Disruptions are not random glitches. They're evidence of pressure at specific points in the system. Understanding where and why that pressure emerged is essential before drawing conclusions about what may follow. Silver occupies a unique position in the global financial system, and that position explains why it often reacts with disproportionate intensity during periods of market stress. Unlike most traded assets, silver functions simultaneously as a monetary metal, an industrial input, and a speculative instrument. Each role introduces distinct sources of demand and risk. Together, they create a structure that amplifies instability when conditions deteriorate. From a monetary perspective, silver has historically served as a store of value and a hedge against currency debasement. Although gold dominates this function at the institutional level, silver attracts a broad base of investors seeking exposure to hard assets with lower nominal prices and higher volatility. This investor profile tends to be more reactive, particularly during rapid price movements. From an industrial perspective, silver is embedded in supply chains that are sensitive to economic cycles. Electronics, energy infrastructure, medical applications, and manufacturing processes depend on consistent access to physical silver. Industrial users are less concerned with short-term price fluctuations than with availability and delivery certainty. When markets become unstable, these participants focus on continuity rather than speculation. Overlaying both roles is the structure of the paper market. Futures and derivatives represent claims on silver that dwarf physical inventories. This imbalance is not inherently problematic. It enables liquidity and price discovery. However, it also introduces leverage that magnifies stress. Small changes in price can force large adjustments in positioning, particularly when margin requirements are recalibrated quickly. This combination makes silver a stress multiplier rather than a simple indicator. When confidence is high, leverage enhances returns and attracts participation. When confidence erodes, leverage accelerates liquidation. The resulting price moves appear extreme, but they are often the consequence of structural mechanics rather than changes in underlying fundamentals. Comparatively, gold tends to absorb stress more gradually. Its market is deeper, inventories are larger relative to trading volume, and its primary function as a reserve asset attracts longer-term holders. Silver lacks these stabilizing features to the same degree. As a result, it often exhibits sharper declines and more violent rebounds during liquidity events. The recent episode followed this pattern. As prices fell, forced selling cascaded through the market. Participants attempting to hedge or exit encountered thinning liquidity. The subsequent rebound was equally sharp, driven not by renewed confidence, but by the exhaustion of sellers and the mechanical nature of short covering. Such price behavior is characteristic of markets under stress, not markets reflecting new equilibrium. Another factor contributing to silver's sensitivity is concentration. A relatively small number of large participants account for a significant share of trading volume and open interest. When these participants adjust exposure, the impact on price can be immediate. This concentration increases the risk that individual risk management decisions translate into system-wide effects. Physical supply constraints further complicate the picture. While paper markets can expand or contract rapidly, physical silver cannot. Refining capacity, mining output, and logistics operate on much longer timelines. During periods of heightened uncertainty, the disconnect between paper prices and physical availability becomes more visible. Even if physical shortages do not materialize immediately, the perception of vulnerability influences behavior. This perception matters. because markets are driven as much by expectations as by current conditions. If participants begin to doubt the ability of the market to accommodate stress without disruption, they alter strategies accordingly. Some reduce exposure, others seek alternative hedges. Industrial users may increase inventories as a precaution. Each response feeds back into the system. Silver's role as a stress multiplier also explains why it often sends signals ahead of broader markets. Its smaller size and higher leverage allow imbalances to surface more quickly. While equity or bond markets may continue to function smoothly, silver can reveal cracks in liquidity and risk tolerance that later appear elsewhere. For entrepreneurs and business leaders, this characteristic is particularly relevant. Silver is not merely a commodity price to monitor. It is a barometer of financial system elasticity. When it behaves erratically in conjunction with operational disruptions, it suggests that buffers within the system are being tested. The implication is not that a single event foretells immediate crisis. Rather, it indicates that resilience may be lower than assumed. Markets can continue to operate under strain for extended periods, but each episode of stress reduces confidence incrementally. Silver's exaggerated reactions make it a useful lens through which to assess that process. Understanding silver as a stress multiplier reframes the recent volatility. The question is no longer why the price moves so violently, but what that violence reveals about leverage, liquidity, and confidence within the broader financial architecture. Implications for decision makers. For decision makers, the significance of disruptions in the silver market does not lie in predicting the next price move. It lies in understanding what such events reveal about the operating environment in which capital, supply chains, and risk are managed. Markets rarely fail without warning. They signal stress through irregular behavior long before consequences become visible at the macro level. The first implication is the danger of equating price recovery with resolution. Sharp rebounds often create the impression that instability has passed. In reality, rebounds following dislocations are frequently mechanical, driven by short covering, liquidity gaps, or temporary exhaustion of sellers. They do not repair structural weaknesses. Decision makers who interpret recovery as confirmation of stability may underestimate latent risk. A second implication concerns liquidity assumptions. Many business and investment strategies are built on the belief that markets will remain continuously accessible. This belief underpins hedging programs, financing structures, and inventory management. When disruptions emerge even briefly, they challenge the reliability of those assumptions. Liquidity should not be viewed as a constant, but as a condition that deteriorates under stress. Counterparty risk is another area exposed by such events. Metals markets rely on a network of intermediaries whose risk tolerance and balance sheet capacity fluctuate. When volatility increases, these intermediaries act defensively. Limits tighten, access narrows. For firms that depend on uninterrupted market access, this behavior introduces operational risk that may not be adequately priced or planned for. The episode also highlights the importance of time horizons. Short-term market participants focus on volatility as opportunity or threat. Strategic decision makers must consider how repeated disruptions affect long-term confidence. Trust in market infrastructure erodes gradually. Once participants begin to question whether markets will function reliably during stress, behavior changes in ways that are difficult to reverse. For entrepreneurs and business leaders, this erosion has practical consequences. Supply contracts, capital expenditures, and pricing strategies often assume stable input markets. If those markets become episodically unstable, firms may need to reassess inventory buffers, diversification of suppliers, or exposure to price risk. These adjustments carry costs, but they also provide resilience. Another implication is informational. Disruptions in smaller or specialized markets are often dismissed as isolated incidents. However, history shows that systemic stress frequently appears first at the periphery. Markets with higher leverage and lower depth reveal pressure earlier than larger, more liquid arenas. Ignoring these signals delays response and narrows options. There is also a behavioral dimension. Markets shape expectations. When participants observe irregularities, they become more cautious. Caution reduces participation. Reduced participation increases volatility. This feedback loop can persist even in the absence of new shocks. Over time, it alters market character from one of confidence to one of fragility. Importantly, none of these implications require a dramatic collapse to matter. Strategic risk accumulates through small, repeated deviations from normal functioning. Each disruption conditions participants to expect the next one. Over time, this expectation influences capital allocation decisions, often away from productive investment and toward defensive positioning. For those responsible for allocating capital or managing enterprises, the appropriate response is not alarm, but adjustment. Stress events should prompt review rather than reaction. Assumptions about liquidity, access, and counterparty reliability should be tested against observed behavior, not historical averages. The silver market episode serves as a case study rather than a forecast. It illustrates how modern financial systems behave when volatility interacts with leverage and institutional safeguards. It demonstrates that markets can appear stable on the surface while exhibiting strain underneath. Ultimately, a question for decision makers is not whether silver will rise or fall next. It is whether the financial environment is becoming more brittle. Disruptions, even when short-lived, suggest that tolerance for stress may be narrowing. In such an environment, resilience becomes a strategic advantage. Understanding and responding to these signals early allows businesses and investors to adapt before constraints become binding. Waiting for clarity often means waiting until flexibility has already diminished.